May from Markets with May. And sorry, I was adjusting my chair there a little bit. Welcome to this episode. We are going to talk about Newell, which is down about 40% from its highs. And it's been down about 5% this week because it was removed from the S&P 500. And I had a few people on a Twitter post that I posted, which you can follow my Twitter down below at Markets with May, comment that they wanted to kind of understand it a little bit better because they were long. So that is what inspired this. I do actually listen to what it is that people care about. So definitely join my Twitter. Let me know what kind of videos you want. I've been a little bit slow making videos recently or doing these live casts, mostly because I had COVID last week. And I just had so many visitors in New York that it's been a little bit out of control. So let's do Newell. I know a lot of you guys have other questions. I will try to get around to those questions at the very end. So stay tuned because I know there's a lot of stuff going on everywhere, even though this is supposed to be the quieter period. Disclosures, past performance is not indicative of future returns. I do actually have puts on this position, though I need short exposure right now because I am net long. And I've been trying to stay more or less market neutral. That is a very specific thing that's unique to me, which is why if you give me a short idea right now, or if you want me to look into something, I am intrigued by researching, although, I want to live my best life too, just like everybody else. So we'll do the best we can. Earnings season doesn't start until October. So I have made that call that I think that it's going to be a very range bound, crazy market. Now let's get into Newell. Okay, the thing with Newell that happened was that S&P in September always does this thing where they add and subtract different companies. Okay, and so Newell, which has been in the S&P for some time, was something that I've been listening to as a function of being in there. And I wanted to potentially go long it originally when COVID first hit, and I missed it. I'm not even going to pretend. And so I've always been watching it to see what's up. It's an interesting company, but there is a lot for the CEO to do. So let me try to do this in a little bit of a different way, since some of you know nothing about Newell and you're like, hey, should I go long or should I go short? Because right now I'm short, but I still trade, so I could go long, and I'll tell you what it would take for me to go long. Here's Newell. Okay, Newell has 3 business line items. They have the learning and development line area, which they try to pretend like is their main focus, but I'll show you the revenues in a second. That's not the part that you have to be careful with. And then the other parts of it is home and commercial. But look at what home and commercial actually is, right? This is all stuff that you would buy for your house to make it nice. Okay. It's not stuff that you're using to renovate. It's not stuff that actually, if you end up with an improvement in the rate cycle, yes, you need to buy this in order to fix the house up to sell it. This is stuff that you buy mostly, even more aggressively when you first move in, but that's where it sits within the consumer cycle, if you will. And then the last piece that they own is the outdoor stuff. These names, for a lot of you guys, you know them: Marmot, Coleman, Contigo. I don't go camping as much, but even I know some of these. So they're pretty great brands, but you kind of have to catch their end markets just right, which during COVID was amazing. Like this is what people bought during COVID. People decided to start cooking, all this stuff. Okay. So you had this beautiful run up in COVID and the CEO looked like a total champ. And then it's just been quarter after quarter of terrible macro that they've experienced, to the point where the CEO that was there before is gone, and we've got this new CEO, and he's got a very particular strategy. He's been with the company since 2018, and in fact, at a past point, he was the CEO and chairman. But that kind of brings you up to the date on the story itself. Let's look at the financials from the quarter as to why I might then have shorted it as a result of things. Okay, so let's look at this. Now, somebody pointed out to me on Twitter, which I love, because if you're short something, you kind of want to know why people are interested in being long or what would make them long. But somebody pointed out to me that they did beat the street estimates. And I get that. If I was a trader and that was my style of investment, I would be all over that. What it tells me is I have to be careful going into the quarter, but I do want to indicate that even though they beat the street estimates, this was their actual performance. Revenue down 13%. Like I said, very tough macro environment. Gross profit down 24.8%. We're going to get back to that. Operating income down 63%. And you can see that that's coming from really it's this gross profit, which is not the place you kind of want to see it, as well as some of these restructuring costs, which will continue. Okay, that's going to continue. You're still going to have the numbers here in the next few quarters, quite frankly. And then, you've got a few items down below that keeps on to where profit was just barely eking over to profitability at down 91%. Now, they swear that a lot of this is the restructuring of the supply chain. So let's go through it part by part. Gross margins down considerably, 23%. Even though your revenue was down 11, there you have to do a double check. Are we getting economy of scale, or what's going on here? They say that the supply chain did this whole thing of onshoring versus offshoring. And so that's an area where in theory you'll see improvement. The problem for me is that if you look at their products, so many of those products are based on like they are sensitive to oil. If you just look at them, this was the original thing that did them in when the CEO was actually living his best life right at the beginning of COVID. And so this is still not an insignificant cost. It's one they didn't discuss a lot on the call, but they've got more than one pretty big exposure to oil if you look at that list of what they do. Okay. The second thing is that they're saying that restructuring, the bulk of the costs are taken out in this quarter and the last quarter. I'm not convinced that that's the case. I think you still continue to see it and they did mention that they continued to have restructuring costs through the rest of Q3, Q4 and into the end of the year. So that number is going to look ugly too. And so they were trying to spin it, but very ambiguous about the timing. When I was listening, maybe a better analyst could hear it differently, but it sounded to me like they're trying to spin it as this is the inflection point. Things are going to get better after this. And so third and fourth quarter would be the bottom. So you want to get in before the bottom. And for me, even though as a turnaround person who loves to look at turnarounds, I'm like interested, I also am very sensitive to being early. It's really what it is, because when the stock trades under 10, the movements can be quite aggressive. Let's call it that. Now, I will show you very clearly that in the next couple of slides, I will show you clearly that there isn't risk of Newell going bankrupt anytime soon. So this is more, how will the turnaround progress? Is it actually cost savings, or is there something else more secular going on? And how small is this company going to have to come down? Because one of the things they're absolutely doing is reducing SKUs, meaning they got a bunch of products. They're going to reduce that number of products by a lot. So yeah, it's so funny. Some of you guys, I love it when you guys post comments. That's true. Make sure you guys have your comments up, because I love the comments and I kind of watch them out of the corner of my eye. So yeah. So now let's look at actually the rest of the financials so we can get a sense for, whether or not you would be interested in this, why I'm also monitoring it to flip on a dime if I would need to, that sort of thing. Okay. So first of all, income statement isn't looking great for them. A lot of wood to chop, but really it's a very tough macro environment. Now let's go through the specifics of revenue. You can see the different line items. And again, they want to focus on learning and development. And Lord knows it has become a bigger percentage of revenue, but home and commercial students is still the biggest chunk. And this is what they reported. And then over here is the year over year change. And you can see it looks horrible, for lack of a better way to describe it. So even the learning and development area is having a really tough time with macro, such that they're down 6. Okay. So what is learning and development? I always think it's really important to remember. So these numbers are more than just numbers. That's Graco. So it's like the baby stuff, baby joggers. It's stuff like that. Elmer's glue should be in here too, but for some reason I'm not seeing that logo here. But I think Elmer's glue is stuck in the learning and development section. Oh yes. So Elmer's glue, Expo, Sharpie, all the back to school stuff is in learning and development. All the writing instruments are in learning and development, but that's only down 6. I mean, in fairness, pens and stuff like that, you've got like a generalized trend in a certain direction. It kind of is what it is, but a lot of that has already come out of the system. So you're going to see greater stability in that learning and development business. And clearly that's the area they want you to, like, when they're waving their hands, they want you to look at. But home and commercial is just such a big chunk of that revenue. And what you would need what you'd need for home and development to actually do better is you'd need for not just a housing improvement, but because of the nature of the type of home and development that they do, you'd need people to go ahead and buy the house. So housing starts would have to increase, then people would have to settle into the house, get past moving in and whatever minor renovations, and then start buying things like candles, pots and pans, stuff like that, for that portion to have what we would call a good macro scenario. Okay. So then it becomes, can I reduce inventory and costs faster than it takes for whatever that's going to look like, which is continuing onwards from last year? In theory, I have slightly better comparables, but in practice, just because I have better comparables doesn't mean this is a great environment for my business. Okay. So one, before we move on to that, like what's going on in the cash flow statement, the balance sheet, let's just go by geography. Everybody's feeling it. Okay. There is not one. Latin America somehow magically eking out because the currency has somehow helped them. But quite frankly, every single area on this globe has approximately the same problem with macro right now. And in particular, housing, I know a lot of you guys have your own independent research as well on that. So take that wherever you will, but that's how it sits. Okay. Cash flow. Here's what I want you to see in cash flow. First, cash flow from operations. Did I do this exactly the wrong way? Operated cash flows from operations. Yeah. So cash flow from operations, this box right here. And I always include cash flow from investing because what you need to do is think about free cash flow, which is going to take that part of cash flow from investing. You're going to take the CapEx out. So you get like a free cash flow number. Okay. So cash flow from operations is up a lot. And it's up a lot because of a few things. Number one, they're destocking inventory. They're decreasing the SKUs, but they're also flat out decreasing inventory. And they're decreasing inventory because they don't see the sales potential there, which means that for the next 3 to 6 months, you have what they call the potential of whether or not they get enough operating savings to overcome the fact that they still need economy of scale. And they talked about that on a call a lot, but I'll show you where it sits on the balance sheet so that if you're doing research, you can look at it, compare it to other periods of time, and if you're super nerd, listen to the call and see if there's any improvement. But this is where you're going to look. Here on the cash flow statement, you can see the inventory decline. You can see as well this accounts receivable. So that's looking fine. And you can see that they're still chunking out businesses to try to like make the business smaller, quite frankly. Don't worry about that. I mean, I thought the deferred income tax thing from last year was weird, but they're fine. I mean, that stuff flows and that's not going to be the main issue in where the other. CapEx is low. So the cash flow from operations or cash flows used in investing is very small, 94. They got more than enough cash. Okay. So cash is not the problem for this turnaround. Timing is your problem for this turnaround. Now, here again on the balance sheet, you can see the inventory matches that cash flow statement just like you'd expect it to. And they're going to continue to do this because they do not see the second half looking like higher inventories. They're going to have to do it on either pricing or gross margin. But remember, this isn't the kind of stuff where you pay up for. Like, you really, like if you're going to pay up for pans, you're really going to need a very specific type of environment to want to do that. Otherwise, you'll wait till next year if you're cash strapped. Similarly, if you're buying plastic Rubbermaid containers, there's almost nobody that's going to pay up top dollar for that somehow. So they're unlike other types of goods and services. I really believe they're very capped on how much they can raise their prices to make up for that compression. Okay, so that is a thing. They definitely talked about it. They're not pretending like that isn't a thing. What they're doing is they're decreasing inventory levels to deal with that. Now, I also want to show you this long-term debt. This bothered me a little bit, this little red box here. Because in theory, if we look at cash flow from financing, they didn't pay a dividend so that they could manage the debt a little bit better and c'est la vie. But I'm not seeing this huge benefit to debt. So let's actually go as well to cash flow from financing operations. You can see they lowered the dividend and then repurchased shares last year. You know, I mean, maybe last year they didn't really, in the summer, they didn't think the Fed would keep going like crazy, which it did, another 200 something basis points after that. So maybe that's why they did it. But this was a poor use of capital given how much debt we're talking about here, $4 billion worth of debt. It's a lot of debt. Okay. But like I said, I'm I'm not saying that this is a story where we need to be truly concerned about Newell. This isn't my most aggressive short on the world, because when I look at the debt, I'm actually cool for them to have this much debt. This is what the debt looks like. Here are what they've got. Anything that has any kind of variable structure to it, they've more or less hedged that thing out to lock in a certain interest rate. Okay, so these are the rates. Their most expensive note is still at 6 and 5/8, right? 6.625. This one right here is their highest interest rate, and that's a very small baby thing. And then let's look at when they owe the debt. So they're good for the next 4 to 5 years. Here's what the obligations would be. Year one, 1.4. I mean, we'll have to see quarter by quarter, but 1.4, I feel like they can do that in a year by just working through the financials more or less. So at least for the next 3 to 6 months, I don't start to have concerns. If this macro doesn't pick up by the first half of next year, then we really have to keep and monitor the cash flow statement and the balance sheet. Now, what I will give full credit to management on is that no matter how many people asked him questions, the CFO just kept saying, no, I'd rather have the cash right now if I could. I think we're going to draw down inventory. We can always ramp it back up. But, cash is not a bad call right now just to shore up that balance sheet. So they're on it, and this is a decent, I don't think we have like a severe management issue going on, but it's just not the easiest. It's just not the easiest macro environment for them to work in. I feel them, but not so much. Okay, here is their guidance. If you like this company, you are going to have to know that they are guiding to a decline in sales. Okay, so their sales outlook is this, but they're guiding on the core component because they're still getting rid of businesses that'll spin out or belong to someone else at the end of the day. We're looking at a 7 to 5% decline or 12 to 10% decline for the full year. So it's going to look ugly through the back half of this year. And that's Christmas, everything like that, right? Operating margins, they're saying will improve. Okay, so they're thinking that somehow that all normalizes out. It's not an insignificant bet, guys, because oil has gone from 70 to 80 and change. I don't think that's their only cost. So maybe they'll make it up in other places, but it's a little aggressive. Okay. And then you've got normalized EPS. So trailing 12 months EPS, 80 to 90 cents, which means that the stock is trading about 10 to 11 times. Now, your only challenge is that in this market, you've got full-on growth tech stocks with crazy good balance sheets also trading at 10, 11 times. So wherever you would normally put that, you're going to have to decide on your own valuation. But for me, if I thought we were definitely like rates are coming down, the world is housing starts are going up, if I had all that clarity versus massive uncertainty around that, I would be like Newell every day of the week. But in this macro environment, as much as I do actually think this management team is a decent set of people, that's tough. That's so tough. I'm just saying it's so tough, and I want them to say, I don't love shorting companies, by the way. I don't get off on it. So, but in this case, I do need to protect my assets as well. So I'm looking for some shorts actively. I'm not going to make this one the world's biggest short, but I definitely will admit to having a position of some puts on this because the puts, I got them as soon as they came out of the S&P 500. And so they're cheap and there's no reason for me to sell them because I got them a little farther out. Now, before I go through the last couple of things, I would just mention coming out of the S&P 500 is a big deal because it does mean all of the passive index providers that were not underweight will have to sell their shares because otherwise they're going to have to justify why they own Newell. And that's aggressive. And I showed you what the financials look like. So it's a pretty aggressive, you'd have to feel really passionate. I mean, you'd have to be very passionate. If you're you just have to be very passionate because you'd be So other final little baby things, guys, put your questions in the comments just in case you have some that, bull versus bear. Okay. If you own this, I'm going to say this very frankly. If you own this and your investment style is to just buy it a small percentage now and then cost average down because your horizon is 10 years or something like that, or like me, I definitely have owned stuff and it's gone down and then come back up. And I've always been shocked by how that is. If you're Buffett style, and you already own it, then you would sell it only because you wouldn't need to sell it. It's not like you have bankruptcy risk going on at this point. Okay. Well, I'll try to keep up with this, even though it's no longer in the S&P. In the future, just ping me on Twitter if I fail to and you care. So there's no bankruptcy risk. There's no like, oh my God, I must sell this if you're just an individual investor that happens to loves these products. If you are a new investor coming in, bear versus bull, you're really needing inflation to be done. If we're talking next 3 months, you need inflation to be done. Okay, but you've been watching oil and really the weirdness of this quarter is that oil, people are pre-buying for winter. We won't know winter. Last year we had the world's calmest, most calm, beautiful winter, such that there wasn't even snow in parts of Europe, right? So if you think that we're going to get a repeat because global warming or whatever your thesis is, then yeah, oil might be spiking now and then come back right after the fall. Usually oil would typically spike in October in front of winter. So it is a little bit crazy that it's come earlier like this. But that kind of is what it is too sometimes. And that's a different video. I know I still owe some of you a video on oil and gas. Sorry about that. Okay. Now you have one benefit, which is they already told you that they're reducing inventory. So possibly this oil spike is not affecting them because they already bought what they were going to buy for the inventory for the fourth quarter. And so they're just waiting on the other side of it. So that's reduction in inventory. The second thing is the mix, because they're clearly trying to get rid of the non-core businesses, either discontinue it outright or sell it to someone if they'll have it. If they'll have them, you know what I mean? It's like a wedding sort of thing. So some of that is going on, and they're clearly moving towards learning and development, which is more stable and less exposed to the housing market, which, I mean, these people are smart that run these companies. They know, they're seeing the same thing I am. Okay. So that is what it is. So if you think that the mix in this inventory is better, then that would be part of the bull case versus the bear case. I happen to think both those things are really scary going into the third and fourth quarter, but I'm not working inside Newell, so that is what it is. Okay. If you think the macro improves and starts to show glimmers of hope in the third and fourth quarter versus the first half of next year, and by glimmers of hope, we're talking about like people want to, for Christmas, buy specifically these products, okay? Or you got a bunch of people having babies or whatever it is, right? So you need that. You need to be well into recovery for this to, in the second half of 2003, for you not want to just wait these 3 to 6 months. And then fixed cost absorption, you really do have to believe that management is going to get those margins down to compensate for the revenue coming down on the fixed costs. So that would be the bear case. I will probably see how this stock trades, because most of what's going on, fair and square, most of what's going on in the stock right now is technical, plus it coming out of the S&P 500. I'll admit to that every day of the week. So I'm going to just kind of see how this thing settles and what valuations it starts to take on. And then depending on what's going on, I may or may not still be in this short by earnings, because I do think that will be the next big data point, and we will know very much so how this particular company is interacting in the macro. All right, let's see what we got. I don't know if there's any kind of questions. I do want to acknowledge people because I really appreciate you guys coming and seeing this. Yeah, fingers crossed based off of fundamentals going forward. That is a little bit like if you're trying to bottom ticket here, really like whatever you want for your full position, just kind of like slowly accumulate it, because even above and beyond the stock, the market conditions between now and October are going to be a little bit volatile. And they're volatile for a lot of reasons. Number one, this week, you still have people coming back from vacation. And then JP Morgan doesn't report until October 13th. And even though there are probably about 20 to 30 companies that report in the S&P 500 before JP Morgan, I mean, and I'm including the ones that did their earnings report August 29th, 30th, 31st. So even though that's true, JP Morgan really starts it off. And then whatever JP Morgan says, so it's usually like JP Morgan, Citi, and Wells Fargo all right on top of each other. And then you got the investment banks right on top of each other. We're going to see if the banking system has stabilized further, and more importantly, whether or not people are lending. Okay. With something like Newell, with those interest rates, and with that much termed out, they should be fine. But the rest of the market, is not necessarily look like this. With particularly a lot of companies in small cap, they can wait because most of them did in fact do the right thing during a 2% interest rate and went ahead and took on some debt to help them out. But eventually, like, you only get, like, if you're lucky, you'll get 5 years on that debt. Corporate debt oftentimes is 5 years in vintage. So 2024, 2025, you're going to want to start thinking about refi coming in 2024, 25. And also, if you've burned through that, you're kind of needing to like figure it out right now. So we're going to hear from the banks about stuff like, we're going to have to, you're going to hear things about like, how's financing going, and like what kinds of deals are being done, and like who's actually got capital. And so I'm going to really be looking at those three companies plus BlackRock, which usually reports first among the asset managers. And then I'm just going to, take a call from there to see what it implies for the overall economy. My puts are far out. My puts are behind bank earnings. I will say that. Yeah, I think they're all behind bank earnings, but I like they're monthly puts, so it's a little bit of a different animal. And I literally, as soon as I saw the announcement, I was like, "Ooh, Newell, you don't have the fundamentals where somebody's going to come in and like and help you out on this massive amount of flow that's going to come in your face as far as the stock market maker, is going. And then and then all of this Labor Day is a weird one in general because people come back in a strange time. And so it's really the whole week of people returning to office and seeing what the additions and subtractions are. So that's why I did the puts. But like, if this thing gets crazy cheap, I'll also be looking for it on the long side. I'm not going to lie, because these they're good brands. You know what I mean? Of course, some of them will walk out will be like booted out for the purpose of just making sure there's enough cash. But there's any number of buyers for these particular brands at a price. Let's call it that. Let's see. That's really, I want to just give a shout out. The buck stop here. Thank you for stopping by. I don't know if you're still here. Novel Diagram. Always appreciate you. Israel, I hope you're doing great. Thank you so much for stopping by. And that's it. We'll keep it kind of short. Good luck out there. Have an awesome, like, kind of ease back into the fall from the summer months. Take care, everybody. Bye.